Hello, Environmental Policy 2 students. Dr. Conway back to you for Lesson 8 on Business Environmental Reporting. This topic also relates very highly to both monitoring and inventory systems that we've already been discussing the previous couple of weeks. There are two broad categories of business environmental reporting that young environmental professionals, when they work for a corporation, often get themselves involved in or are told to be involved in, and that is government mandated reporting for specific environmental issues, and that can be a number of different reports for a large company in a given year, depending upon the regulation. That can be reporting for chemicals, reporting for greenhouse gases, reporting for wetlands, reporting for any number of obligations created by regulations, and that's an important issue for all businesses because, of course, these reporting systems are often regulatory mandates, and therefore compliance, promotion, and enforcement procedures will be in place for those reporting requirements. The other type of reporting is what we call corporate sustainability reporting, and those are things that the government does voluntarily because they see value in doing it. Now, obviously, when a company does its monitoring, its environmental monitoring, and builds its inventory systems, the primary objective of those for a company are for compliance, promotion, and reporting, are compliance, promotion, and enforcement reporting requirements, and that's why a company builds these systems, and obviously is a major driver of those systems, along with basic human decency and protecting workers and so on and so forth. But the regulatory obligations are quite clear, and that goes for Canada's Pollutant Release and Transfer Registry, the NPRI, National Pollutant Release and Inventory System. That includes the National Chemical Inventory System, Canada's Greenhouse Gas Emissions Reporting Program and Inventory. And that was introduced in 2004 and tracks greenhouse gas emissions for companies that emit more than 50 kilotons of GHGs in carbon dioxide or equivalent units per year. And so each of these reporting requirements you may find yourself involved in, and there's substantial exercises to either track chemicals or track GHG emissions, track any number of different factors that may be regulatory obligations placed on the company you're working for. And these reporting processes are very systematized. You have to report by a given time on specific topics. And so it's important to understand those inventory systems, because many of you, when you start your career, will be involved in inventory systems and related reporting. And that's just the reality of working in the private sector in this field. But business leaders also expend tremendous amounts of resources to report on sustainability reporting for the company, because that is seen to have value to the company in terms of its public recognition, its willingness to comply and go beyond compliance with respect to regulations by the government, and so on. Many employers will feel that providing information to financial capital, shareholders, employees, the public, and other stakeholders increases the brand of the company, increases awareness of achievements and challenges. Establishes committing to a sustainability report also establishes internal awareness raising amongst employees and so on, and that improves. The studies have shown improves social responsibility, environmental responsibility of the company overall, well beyond the intent of the sustainability report, because it does raise awareness amongst employees of the importance that the management or the board of directors places on this issue, and that can have a very positive effect, much like establishing an environmental management system has for a company. Similar effect. And of course, branding and positioning as a green company in the marketplace is a huge issue. Look what happened recently when Volkswagen was caught with the diesel cheating scenario, the damage it did, billions of dollars in regulatory costs, but many billions more in the loss of the brand of the company. And now when people talk, clean diesel, they chuckle when they think about VW, a Volkswagen. Whereas prior to that, Volkswagen was selling itself as a clean diesel, they called it, and this, that, and the other thing, and they spent billions over many years developing that brand, and it was gone overnight. The cost can be huge. And the sustainability report also allows you to track progress. I mean, when you do your sustainability reporting, you're reporting on how well the company's doing in achieving its green goals or its sustainability goals. And that very active internal tracking and reporting, it puts pressure on managers within the company to not show that they did worse this year than they did last year. So it's a public peer pressure kind of a document that encourages managers to do a little bit better every year, and that in itself can be the invisible manager and putting pressure on managers to become to oversee cleaner operations, and that's very valuable to a lot of companies. It also allows the company to report on case studies and pilot projects that have been successful and share that information with the industry at large, and with other companies at large. And that can become very, very valuable. When companies make major initiatives to move in the direction of cleaner technology, and then they report on that in their sustainability report. Yes, patting themselves on the back, but they're also sharing experiences with other companies, smaller companies perhaps that don't have the same amount of resources, that can then take up that initiative and become cleaner themselves. Okay. And it's a commitment. A sustainability report, reveals a commitment to stay competitive while being green, and that message is very critical in the marketplace today. As we bridge that gap between, it's either economy or environment. No, what a good sustainability report will show is that the environment is critical to the economy and vice versa. And it's that total integration that a sustainability report for some of the more larger and more progressive companies has a very positive effect on environmental policy and on public willingness to accept environmental change. So all of these factors, progressive companies that have solid sustainability reports see the value of that. And these are not regulatory obligations, but they definitely do help the company in terms of its public image with government. So when regulatory issues crop up, there's a willingness to cooperate beyond what would be the case if we had a bad actor, a perpetual bad actor, and the company had to undertake a regulatory action. The circumstances would be quite different. So corporations see a lot of value in voluntary sustainability reports, and a lot of young graduates will find themselves involved in that, either through consulting firms or with companies themselves. But the first category for sure is something that if you work for a company, you'll come up against regulatory reporting requirements and the need for systematic information to provide those information required for those reporting requirements. And that relates back to monitoring and inventory systems. And so the integration of all of these topics is critical to understand. So make sure you're well aware of the central role that these tools play in private sector environmental management. Okay, we'll be back to you for week 9 next week. Cheers. Bye-bye now.